Hey, this is Justin with DayTradeTheMarkets.com and DailyMarketAssistant.com. And what I thought I would do today, I thought it was a really interesting day, a little choppy day, but it was a good day to really illustrate each piece of what we call evidence and create a chart starting with just a price chart here and then add each piece of evidence along the way to help you make better sense of the market. And when I talk about market evidence, the way we look at it is we have various tools and pieces of evidence that we apply to a chart and apply to our thinking about the market. And the idea is that these are all like pieces of a puzzle. And the more, just like if you're doing a puzzle on your table, the more pieces of a puzzle that come together, the clearer your picture of what's going on. And so if you can get not just one, but two and three and four and five of these pieces of evidence to line up at the same time, your edge, your chance of success goes drastically up. Doesn't mean it's always going to work out 100%. Nothing is that way. But your odds, your chance of success is much higher, and that's really what trading is a probability game. So what I thought I'd do is just go through each of these pieces step by step and build a chart out and just kind of show you what that means. Well, we start with what we call our bigger picture bias and bigger picture key levels, because it's really important to not just be so laser focused or in a vacuum about today's chart or whatever time frame you're trading, but to also have the context of the bigger picture. And that was a big breakthrough personally for me in my trading a few years ago when I put that piece together. I was always so focused and fixated on what was going on with my signals on my chart at this moment that sometimes they'd work, sometimes they wouldn't. When I learned to utilize the bigger picture context of the market to say, okay, when does my trade signal make sense and when does it not make sense, that's when things really turned. I really look at that as a huge breakthrough for me personally. So when we talk about bigger picture bias and bigger picture key levels, one of the tools we have that we just released actually, and I actually would welcome you to take a trial. You can go to this website, DailyMarketAssistant.com. We've got this free 14-day trial. If you haven't already done so, I highly recommend doing it. And what this is going to do is going to help you for a lot of different markets get a little bit better feel for what's going on. So, for example, when we go to the Daily Market Assistant prior to January 17th, which is today. This video would apply even if you're watching this down the road. It's the same idea. We have a lot of different markets here: ES, Nasdaq, Russell, bonds, crude, gold, a lot of ETFs and so forth. But I'll just look at the I'll just look at the ES for right now to keep it simple. And when we talk about bigger picture bias, we look at the bigger picture bias both from a day trading perspective and also a swing trading perspective. And heading into the day, the bias is up for both of those. And this day trading bias would switch if we had spent a good amount of time below 1834.25, which we had at the end of the day. So we really wanted to monitor at that 1834.25 level and also some of these other key levels that these happen to be near the market. So what I always do and what I recommend doing is you start your day by marking your chart up with these levels and for whatever markets you're trading. So again, our bigger picture bias is up. So what I would do is go over to my chart and let me get rid of this stuff. I would draw an arrow just with an up bias. And obviously this chart, this price action wouldn't be there yet, but that's the thing that we would do. Then I would look at some of the key levels, and we know that 1834 is a big one as we put here. And then we'd look at 46.50, 41, 34 quarter, 28.50, 23, and so forth. So just kind of mark those up with horizontal lines. So 46.50 is it's not in my screen right now, but I look at 41, so I put a line there. 34 quarter, obviously that's an important one here. So I make that a little bit bigger personally. Then we've got 28.50 right in here, below that 23, but those are the levels that come into play. So you can get that from the Daily Market Assistant. And again, so all things equal, bigger picture, we would rather be on the long side, and we really want to monitor what the market does at these key levels if they test it, right here at 34 quarter, up there at 41, so that if you have a level where the market's below and it tests up there, you'd want to be careful getting long at that area, and that'd be a better spot to be getting short. If the market tests into a support zone, it's a good spot to be getting long. Be careful if you're getting short. Okay, so that's how the bigger picture context can come into play in this situation. Okay, so if we go back to our market evidence illustration here, we've talked about these bigger picture bias, bigger picture key levels. The next thing I want to talk about, or that I'll add, are what we call relative aggression bars and high velocity moves. And this is really of the day trade the market software, this is really the most important part. This is really telling us what's happening in real time under the surface of the market, if you will. So what we're looking for is the market only moves if one side, that's buyers or sellers, is more aggressive than the other side. If there were no aggressive participants in the market would just sit there. It would just be a bunch of people with limit orders and the market wouldn't go anywhere. But if collectively one side, either buyers or sellers, becomes more aggressive at a given time, that's when the market's going to move up or it's going to move down. And so what this software is doing, it's giving you level 1 or moderate, level 2 or strong, and level 3 or extreme buying and selling aggression bars. And so what that's telling us is at any given moment in time, for whatever time frame you're using, whether it's a 5-second micro chart or a 15-minute swing trading chart or anything in between, I tend to look at the 1-minute chart on the ES. It's telling you in that moment of time which side is more aggressive, okay? And not only that, but it's telling you to what degree the side is more aggressive. Is it, again, moderate? Is it strong? Is it extreme? And by following along with these bars and seeing if we have follow through or if we have rejection, it gives us a pretty nice roadmap to the short-term direction of the market. So if I go back to our chart, and again, it's just naked price at this point with some bigger picture levels, and then I insert just the aggression bars, here's what the chart will look like. And you can see I know the chart's a little scrunched up because it's I'm trying to fit a lot into a small screen here, but basically the idea here is that we've got these key levels. Here's the first level 3 or extreme selling aggression bar, and we have another one, and so it looks like this market's selling off, which it obviously is, but here the bigger picture level with the bigger picture bias, instead of just jumping on board blindly, this is telling you, be careful. Better not get short in that level. Better see if we can get through that level. Then you can start to see some extreme buying starts to come into the market. We move higher. That's off of this level. Pretty good spot, right? And then you can see we get up to this level around 41. We get to within 2 ticks of it. And again, it looks like the market's going to the moon, but you know to be a little more careful, to make the market prove itself above this 41 level, because this bigger picture resistance area is there. Is that always going to hold to the tick? No, but it's giving you a guide. It's giving you a little bit of a guidance to help you stay out of a bad trade. If you can avoid just one loser a month, it makes a huge difference, right? So then you can start to see some extreme selling comes in till we get down to this 34 area. The market finds some support again. And when we finally break through, we see that it's legitimate because we have more level 3 selling. We get to about 3 ticks from the next level down, and the market starts to get some buying back again. And again, it looks like, is this thing going heading higher? Well, no, you better be careful. We're right back into that 34 level. And that's the end of the day on a Friday anyway, so you got to be careful. But that's the idea. These level 2 and level 3 bars especially are really giving us a nice guidepost as to which side is more aggressive at a given time. If you can find a situation where, say, a level 3 bar has quick follow through, that's showing us that sellers are really in control at that point. And if the market comes back and tests to the higher low, it's probably going to hold. Same thing here. Here's another one, level 3 bar. Right away, comes right back down to the low of it. Here's another one. Here's another one. So that's the idea, and you put those in line with what else that you're seeing, what other pieces of evidence there are. Also, here are what we call high velocity moves right in here. Here's another one. Just another way of showing that there's pretty strong, in this case, selling coming into the market at that moment in time. Okay, so that was we've talked about. Again, bigger picture bias, bigger picture levels. We talked about relative aggression bars and high velocity moves. Let's talk about the directional filter at this point. So let me throw that on the screen. Okay, down here at the bottom of the screen, you can see this filter, and it's got gray, which is neutral, light green is bullish, dark green very bullish, pink is bearish, and dark red is very bearish. And what this is telling you, is this the be-all end-all, this filter? No, that's not what this is, but it's giving you another little piece of evidence that's telling you what the short-term path of least resistance it likely is. So again, does this mean this is the only thing you'd ever use? No, but it's another piece of evidence. So if you're thinking about a long and the filter's green, that gives you that extra % or 2 of confirmation. If you're thinking about a short and the filter's green, does that mean you can't take it? No, that's not what it means. It just means you better think twice. The path of least resistance seems to be to the upside, so you may want to be a little bit careful. When this thing turns over, then it's saying, okay, be careful on the long side. Okay, so that's that's what the filter is telling us. It's just another piece of evidence to help you make better trading decisions. And obviously, as a trader, that's what we are. We're professional decision makers. The better we get at making decisions, the better our results are. So if you focus on making better decisions, the results will take care of themselves. Okay? So that was that piece. The next piece we want to look at. So again, just to recap, we've looked at bigger picture. We've looked at the filter, we've looked at the aggression bars and high velocity moves. Next, let's throw in the support resistance zones, which form as you see them here on the chart. So let me put those on the chart now. Okay, now you can see on this chart that we've got these green areas, which are support. When they turn over to red, they're resistance. When they're red, they're resistance. And what is this telling us? It's telling us that short term, that's what the likely support resistance area would be. So if you're thinking about getting long right here, be careful. That's a potential resistance area. If you're thinking about getting short right here, okay, you've got a little more evidence in your favor. Okay, so that's the idea. It's just another piece of evidence. Is that the be all end all? No, but it's another piece of the puzzle that the more of these that come together, the better off you tend to be. So that's what those support resistance levels are. Okay. Next, let's talk about we'll talk about deceleration and divergences. Okay, and what these are telling us very short term when the market is likely to have a turning point. Okay, so let me throw those on the screen. Okay, and now you can see that we've got some of these dots and triangles and darker dots. They're just three different calculations to get to the same basic idea, which if we just look at this one here, you can see that this bar has a lower low than the prior bar. But within that bar, within the order flow of that bar, the selling aggression is actually decreasing. Because what if we had a bar that had here's a bar and the next bar down had a lower low, and the level of selling aggression in this bar is increasing? Well, then the expectation would be that it would continue lower. However, what if the level of selling aggression in this bar is actually decreasing or decelerating? Well, then the expectation, at least short term, would be that the market would turn around. Okay, so that's what these diamonds or these triangles and dots are telling us. That's when the market's decelerating. I want to be very clear. This is not some kind of blind trade entry. This is not some systematic way of just blindly taking these. If you do that, you're going to get killed. But if you can utilize these levels of deceleration when there's other pieces of evidence to work with, then your edge is increased greatly. For example, here's a situation where, again, heading into the day, we know that our bigger picture bias is up. We know that this 34 quarter should act as support. At the moment in time, the filter is green. We come down to this level, we decelerate. Okay, then you've got some pieces of evidence that are coming together. Okay, but you wouldn't just blindly want to get into a trade. Same thing here. We've started to see some selling come into the market. Again, we started to see some selling come into the market where our filter is weakening. There's a level of resistance in here. Now we get some decelerations. Well, you've got other pieces of evidence to work with. You don't just want to blindly take every single deceleration. I just want to be real clear about that. Some people see arrows or triangles and they think, oh, trade entry like an animal, and that's not what this is. This is for your thinking where you want to utilize it with other pieces of evidence. So again, the idea here was to show the different pieces of evidence, market evidence, how they come together. How, if you like to think about your trading during the day and not just be robotic about it, how this can help you make better decisions. How if you can just make a few better decisions a month than you might have otherwise, you're coming out way ahead. So that's the idea here. So again, with this, just to be clear, we do have two different sites that we run. This Daily Market Assistant is new, but Daytrade the Markets is the site with all this software that's in real time. Some people will use one, some people will use the other one, some people will use both, and they work great in conjunction, as you can see. But you could certainly use one or the other or none, whatever suits you. But if you are interested in this newer site, Daily Market Assistant, you can simply go to the Daily Market Assistant page and take that free trial. It's very simple to sign up, and you can have a look. And if you're interested in the Daytrade the Market software as well, contact us. We can work something out with you. So hopefully that makes sense. Everyone have a great weekend, and we will talk with you soon. Thanks a lot.